Welcome and thank you for standing by. At this time, all participants are in listen-only mode. After the presentation, we will conduct a question-and-answer session. Today's conference is being recorded. If you have any objections, you may disconnect at this time. And now I'd like to introduce your host for today's conference, Paul Gilman. You may begin.
Thank you, Jeff. And hi, everyone. This is Paul Gilman. I'll be presenting today's SAM webinar on SAM's Power Purchase Agreement Financial Models. This is the second in the series of webinars that we're offering this year. You can see the rest of the schedule on the SAM website on the learning page. Next up will be residential and commercial PV projects in SAM on July 10th, and then July 24th, we're going to introduce the relatively new SAM software development kit. For today, like I said, we're going to talk about the Power Purchase Agreement financial models in SAM. I'm going to start with a short demonstration in SAM, and then I'm going to give you an overview of the financial models, and then I'll spend a good chunk of time talking about the PPA model metrics, and then discuss some techniques for troubleshooting the results of the PPA model. I tried to design this session to address a number of questions that I've gotten over the years about the SAM PPA models. Just an idea of the type of things we're going to be talking about. So let me start with the demonstration in SAM. I just wanted to mention one logistical thing, which is if the screen, my screen isn't completely visible in your live meeting window, you can try the little button in the bottom right corner of the live meeting window. There's a full screen button and some zoom options there that might help you fit my screen better in your window. So I'm assuming that most of you have had some experience with SAM, but I'll try to give you enough detail in case this is the first time you've seen it. So this is the welcome window, what you see when you first start SAM. And let's see, before I jump into here, I should also mention that, as the operator said, we'll try to leave enough time at the very end for Q&A over the phone. But if you have questions as I'm talking, please feel free to use the Q&A window, which you can get to from the little menu there, and type your question, and I'll try to monitor those and answer them as we go. And I've also got some friends over at NREL monitoring things to help out if there are more questions than I can answer as I talk. Okay, so this is the SAM welcome window. To create to model a project in SAM, you create a file, which you can either do by clicking the Create New File button, or how I like to do it, which is click File New. That shows this window here where you see a list of performance models that are available in SAM, the various renewable technologies SAM can model. And as you choose a performance model, so if I look under photovoltaics, and I'm clicking here to make these lists expand, I click photovoltaics, and then I'll choose the flat plate PV model as my performance model, and then SAM displays a list of financial models that are available for this particular performance model. We're concentrating on the PPA models here, so that's Commercial PPA, Utility IPP, and then some advanced models as well. I'll talk through these different options later. I just kind of want to introduce you to the interface at this point. So let me start by choosing the Utility IPP model. And so after I choose my performance and financial model, SAM then creates a case in my file. So I have one tab in my file, and it's a flat plate PV model with the independent power producer financial model. Along the left here is the navigation menu with buttons that I can click. And each time I click a button, I see a set of inputs here. So if I click the module button, those are the module inputs, inverter inputs, array inputs, and so on. We're focusing in on the financial model, and the financial model inputs start down here at PV system costs, or arguably performance adjustment. But in any case, the performance model inputs are at the top of the list, and the financial model inputs are at the bottom. So we'll start here with the system cost page, and what I can see is that we've got costs broken down into various categories. We've got direct costs or hard costs, indirect costs or soft costs, and then down at the bottom, operation and maintenance costs, O&M costs. So you put in your system costs here. There are, as you'll notice, default values for all the costs. These are just values that we've put in the model to help you get started. But of course, when you're actually modeling a project, you need to go through all these inputs and make sure that they're appropriate for your analysis. The cost categories here are basically a bookkeeping tool that kind of help you think about what the cost contributing to the total installed cost. So that the total installed cost, which is calculated here in blue, so these numbers in blue are calculated numbers that you can't change. The total installed cost is the sum of the direct and indirect costs, and that is the number that goes into SAM's financial model. So how you break down the costs into categories here is not important to SAM. What is important is that the total installed cost is the one that you intend for your project. The direct and indirect capital costs and the total installed costs are year zero costs. So this is the initial investment in the project. And then under operation and maintenance costs is where you tell SAM what it costs to operate your system. So these are project costs that are incurred in years 1 and later. And you can specify your O&M costs in one of 3 different units. So either a $1 per year cost, or a $1 per kilowatt of system capacity per year, or a $1 per megawatt hour of production per year. So that your O&M costs can either be fixed annual costs, they can scale with the capacity of the system, or they can scale with the amount of electricity that the system generates. You can specify the O&M cost as a single value, as we see here for each one. So for example, the fixed cost by capacity is $15 per kilowatt per year. We also have an option, and this is true anywhere in the SAM user interface where you see this little blue and gray button. You can specify a set of O&M costs in what we call an annual schedule. So when I click the button, this changes from a number to an edit button. And if I click the edit button, then I get a list of years. And so this is we've got 50 values by default. I'll make it 30 values for a 30-year project. And then I have 30 dollar per kilowatt values that I can enter. So I can put in a O&M cost on a year-by-year basis. So this is useful if you have a nonlinear, year-to-year pattern of costs. All right, so those are the system costs. That's one of the more important inputs to the financial cost model. On the financing page is where you specify the financial parameters for your project. You'll see we've got the solution mode here at the top, which I'll talk about in a moment. You specify the internal rate of return for the project and a PPA price. And then as you scroll down the page, you'll see there are inputs for the project debt, project loan parameters, analysis parameters, inflation rate, real discount rate, taxes, insurance. And then at the bottom is a little calculator to calculate the construction financing cost that SAM assumes the project covers in year 1 or year 0 as part of the total installed cost. So construction financing, this is to account for financing costs in the 6-month to 12-month period generally before the project is actually installed. Don't confuse construction financing with the project debt. The project debt is, these loan parameters are for the cost of financing the project over its life. Solution mode, now this is where you tell SAM how you want it to run the financial model. So you can either tell SAM that what the internal rate of return target is that you're looking for your project. And so you specify a minimum IRR here, and then SAM calculates a PPA price as a result. So if we run the model in specify IRR target mode, as I'll do here, I'll click the green arrow button here for run. That runs the model, and then I have a metrics table here in the bottom left corner of the screen, and then some pretty graphs here on the right. We've got the project cash flow, monthly output. What I'm interested here is this PPA price. So on the financing page, I specified an internal rate of return. I said I need a 10% internal rate of return, and SAM calculated that to meet that internal rate of return, I need a 14.4 cent per kilowatt hour PPA price. If we look at our internal rate of return, we see that it's almost 19%, which is quite a bit higher than the 10% I'm looking for. And then if we look at our net present value, we see that this project has a pretty high net present value as well. So what I can do now is say, well, this is for a PPA price of 14.4 cents per kilowatt hour. What if I go back? What if I lower the PPA price? So then I can switch over to PPA price mode, specify PPA price. That grays out my IRR target inputs. And then I can change the PPA price to, I don't know, something like 12. Now, the PPA price was an input. It's fixed at 12, and SAM calculated the internal rate of return, which is 12.8%. That's closer to the 10% minimum that I need, and then I have a little bit of a smaller net present value. So you can run the model in either direction, either solving for PPA price or solving for IRR. And as you notice, I looked at the PPA price, the internal rate of return, and the net present value all together here to kind of evaluate what's going on with my project. We'll look at all of this in a lot more detail in just a moment. What I'm trying to do now is just kind of introduce you to the SAM user interface so you can see where what I'll be talking about in my slides is coming from. So that's the financing page. Let's look at some of the other inputs on the financial model inputs. These time of delivery factors, these are for the case where you negotiate a power purchase price. So your PPA, your power purchase agreement, involves both a PPA price and a set of multipliers. So in some markets, for example, in California, you negotiate a PPA price, but then the utility will give you a higher rate during times of high demand. So, for example, if we look at this PG&E set of multipliers for 2009, we see that we've got a set of multipliers for period 1. That's this area with a 1 on the matrix. So during weekdays in July through September and from noon to 7 p.m., the project gets the PPA price times 2.2, so more than double during these periods. In period 3, which is indicated here with where the numbers 3 are, so that's the summer nights or late nights, early mornings, then we only get about a little more than 2/3 of our PPA price. So we can model this unique situation where the PPA price comes with a set of multipliers. What we call uniform dispatch here just disables that and sets everything to 1, so that way your PPA price is applied uniformly throughout the year. The incentives page, that's where you specify incentives for the project. And we've got a bunch of different kinds of incentives. We tried to make this flexible enough to model most of the incentives that are out there. There are some that can't quite be modeled exactly, but we can get most of them. So you know, we've got the ITC, PTC, and various other incentives here. This is also connected to an online database, the Desire database. So if you click Download Incentives, you're presented with a list of incentives that are available for the location that you're modeling. The incentives from the database may not be completely up to date, so we would recommend using this as a starting point. You can choose your incentives here, but then when they're populated in the input page here, you should go through, as always, and make sure that the inputs are what you intend to model. The Download Incentives button is connected to the location and resource page. So we're modeling a system in Phoenix, and so this is going to download incentives that are available for Arizona and Phoenix. Next is depreciation. So we model accelerated depreciation if it's available to the project, and that's it. Those are the inputs for the financial model in SAM. This is the independent power producer model. If I create another case here, I can show you what the single owner model inputs look like. And again, I'll describe these in more detail in a moment. And I'll just show you that the financing page, all the other input pages are the same. The only difference is in the financing page and depreciation too. But the financing page is where the bulk of the difference is between the two financial models. So if I switch between the financing pages for the IPP and the single owner model, I can see how they differ. So the two models have a different way of modeling project debt, which I'll describe later. And we've got reserve accounts in the single owner model that we didn't have in the IPP model. There are also other partnership models. I guess I can use any technology. We could look at a parabolic trough system. And let's take a look at the all-equity partnership flip model. And the financing page for this model, we can see that we have many of the inputs are the same as in the other models, but we've got targets for a tax investor and a developer for the two partners involved in this type of project. So that's a quick tour of the financial model inputs in SAM. Now let me switch over to PowerPoint and give you a quick overview of what we just saw. So to back up a moment, I'd like to point out that SAM can model two types of projects. We're focusing on PPA models, but we can also model distributed projects in SAM. So these are projects that buy and sell electricity at retail rates instead of at a price negotiated through a PPA. We are hoping to add a residential lease model to SAM at some point if we can get the funding for it. We've gotten many requests for it. We know it's a commonly used model. Unfortunately, for the moment, SAM can't model the residential lease project, at least not from the homeowner or building owner's perspective. So we can model a residential lease from the lessor's perspective. You know, where you want to know, well, if I'm a lessor in one of these arrangements, what PPA do I need to get to meet my returns requirements? But hopefully we'll be able to add this in the next couple of versions of SAM. A distributed project involves a building load, so you have to provide SAM with data about a load. We don't care about that for a PPA project because the PPA project sells all of the electricity it generates to an off-taker at the PPA price. This is a picture of a large-scale utility PV system that's ground-mounted, but you can model a roof-mounted system or one that involves any of the other technologies SAM can model, like parabolic troughs, power towers, wind, geothermal, or other. Okay, so there are several models for PPA projects. The commercial PPA and utility IPP model are basically two versions of the same model. They are the original financial model in SAM. And they assume that a single owner builds and operates the project, that was sort of an important feature of these models is that the debt fraction is an input. So you specify the project debt as a debt fraction. The advanced utility models there's one single owner one. So the single owner advanced model models the same type of projects as commercial PPA and utility IPP, but it includes reserve accounts, and SAM calculates a debt fraction based on a debt service coverage ratio that you specify. So it has a different way of modeling debt, and it includes reserve accounts. And then the partnership flip models, there are two, one that involves debt and one that's no debt, so all equity. Those models assume that there are two partners in the project, a tax investor and a developer, and they share the costs and benefits of the project. And then the benefits go to the developer after some number of years. So this is for a situation where the developer doesn't have sufficient tax liability to take advantage of tax credits, so they partner up with a tax investor who can take advantage of those benefits. And then the Sale Leaseback model is another financial structure, but instead of a flip year, there's a lease arrangement involved. So the tax investor purchases the project from the developer and then leases it back to the developer. Here's a summary of the differences between the IPP and the single owner models. So with the IRR for the utility IPP model is over the entire analysis period, whereas for single owner you can specify the target year for the IRR. As I mentioned before, project term debt is handled differently between the two models. The utility IPP model has a set of constraints that I'll get into a little bit later, but it also allows you to have SAM calculate an optimal debt fraction for you, or PPA escalation rate. So there are these optimization options and constraints on the utility IPP model that are not part of the single owner model. And again, as I mentioned before, the reserve accounts are available in the single owner model. So those are explicitly modeled in the single owner model. In the utility IPP, you'd have to include those reserve accounts in your operating costs. And as I showed you, you can compare the financing page to get a sense of the difference between the two models. So the models in SAM, these are general pro forma models. As always in SAM, we're trying to strike a balance between simplicity and sufficient detail. So for the financial models, we've got hopefully enough detail for a pre-feasibility, where you're at the stage of evaluating a project. So you might use SAM, to help you prepare a proposal, or if you're evaluating proposals, you could use SAM to evaluate submissions. You would not use SAM to prepare your finances to present to a potential lender. For that, you'd need much more detail. And the model is simple enough to run quickly and give you results in just a few seconds. The models for single owner projects, so PPA commercial, utility IPP, and single owner, assume that there's a single entity involved in the project, and that the project has sufficient tax liability to benefit from all the tax credits. And then the partnership and sale leaseback models, those are obviously going to be simplified representations of actual partnership agreements. So an actual agreement is going to have a lot of detail that's negotiated by the lawyers for the two parties and will be much more complicated than what SAM models. But again, hopefully SAM has enough detail that, if you're considering entering into a partnership, you can get a sense of what kind of IRR, what kind of PPA price you would need to make the partnership work. Here's a quick diagram of what's going on behind the scenes when you run SAM. So we've got inputs. That's the stuff that you give SAM. Those are the green arrows there. And so you've got inputs to describe the physical system, and then a set of performance adjustment factors, which I kind of glossed over before. But those are a set of factors that you can use to model things like system availability or system degradation, scheduled outages for maintenance, curtailment, anything that affects the how much energy is actually going to be delivered to the grid that's kind of outside of the control of the project. And then you've got cost and financial parameter inputs that go into the financial model. And then these are sort of separate modules within the model. So the performance model does an hourly simulation, assuming that there are 8,760 hours in a year, and calculates the kilowatt hours that the system produces. And then we apply the performance adjustment factors to adjust those kilowatt hour numbers. And then those kilowatt hours get fed into the financial model because that's how we calculate revenue. And then SAM displays lots of pretty graphs and tables from each of these modules of the model. So we can look at hourly data, monthly data, annual data related to the performance of the system, and then we can look at things like the cash flow and the annual output that are part of the financial model. This is sort of another representation of that, sort of focused in on the financial model. So we've got the performance model calculates the kilowatt hours. So that gets adjusted by the performance adjustment factors and goes into the cash flow model, which is down here at the bottom. And then the inputs that you provide, sort of up here on the top right, those go into the financial model that feed the cash flow. And then so SAM calculates this cash flow and then displays a bunch of metrics in this metrics table. All right, so let's spend a little time talking about these metrics. Each model reports a different set of metrics. I'm showing you the metrics table from 3 of the models: utility IPP, the single owner model, and then one of the partnership flip models. As I showed you when I was playing around in SAM, you want to sort of consider the results as a set. I often get questions from people who are sort of thrown off by the results because they're focused in on one metric. They're only looking at the PPA price, and it looks like they're getting a ridiculous PPA price, but they haven't checked to see whether the net present value is positive or whether they're getting a reasonable internal rate of return. So consider these metrics that I've highlighted in blue as a set. And then for our partnership models, we have a IRR and net present value for the investor and developer. So for each partner in the arrangement. The financial metrics are calculated from the cash flow. So in addition to taking these different the whole set of metrics together, you should also have a look at your cash flow to make sure that it looks reasonable. So now what I want to do is go through each of the metrics in a little bit of detail, starting with the cash flow, which is where everything begins. So the financial metrics are based on the net after-tax cash flow, and a negative value means that it's a cost to the project, and a positive value means that it's a benefit to the project in any given year. The year 0 value in the cash flow is the initial investment adjusted for any incentives, and including the construction financing costs if you included that in your modeling. And then years 1 and later account for revenue, expenses, taxes, incentives, and debt costs. We have a cash flow, the after-tax cash flow from the project perspective, and then for partnership models, you have the after-tax cash flow for each partner. SAM applies the inflation rate that you specify. You know, on the system cost page, you specify your O&M cost as a year one dollar value, and then SAM applies the inflation rate to calculate the out-year values. SAM doesn't apply inflation to revenue, so the revenue, the PPA price is assumed to be fixed unless you specify an escalator. So that's just for consideration as you're thinking about what discount rate to use for those who are thinking ahead. So that's the cash flow. The net present value, so that's the present value of that after-tax cash flow. And as we know, a negative value may indicate that your project's not feasible. We have NPV from the project perspective, and for partnership projects also from each partner's perspective, and then just reiterating the role of inflation in this. So this is the general equation for the net present value, and then I'm just showing the detail of how the cash flow is calculated in each year. Internal rate of return, again, as we know, the definition is the discount rate at which the net present value is 0. This is the nominal discount rate in SAM. And this is a graph that you can create in SAM to show that how it calculates the discount rate. So we've got net present value over a range of discount rates. The discount rate is where this line crosses 0. So anything less than this point is a profitable project, and anything greater than this number is not profitable. And of course, this depends on the discount rate that you choose. So that's assuming that you've chosen a reasonable discount rate to represent an alternative investment. SAM displays the cash flow table. So let me just take a moment to show you that in SAM. If we go to the results page, so I'm just going to calculate some results here for the partnership model. Jumping through the data here. So on the results page, we've got our friend the metrics table with results for both partners. We've got graphs. Here's my cash flow graph. I can find it in the thumbnails here and click it to show it alone. There's the after-tax cash flow for the project. If I go to the cash flows tab here on the results page, here's a detailed cash flow for the project. So I can dig into what's going on with, my operating expenses and all sorts of interesting things. But it's kind of hard to find where is that after-tax cash flow. So it's under total project returns, and then I go to after-tax, and then is it cash? No, it's not the cash flow. It's the total cash flow. So it's this row right here. So that's what I've done in these slides, is tried to point out where to find that pesky after-tax cash flow. So for the utility IPP and commercial PPA model, it's after-tax net equity cash flow, single owner, after-tax total. And then for the partnership flip and sale leaseback models, the different partners' cash flows are shown in the rows that I've pointed out there. Maybe at some point we'll have the time and money to clean this up a little bit in the cash flows to make them a little easier to find, but at least for now you have these slides to use. What about the PPA price? So that's the price paid to the project for the electricity it delivers to the grid. As I showed you, it could be modified by a set of TOD factors. That's optional. And it can be either an input or a result. And the PPA escalation rate, which is an important assumption, it has a pretty big impact on your PPA price and IRR. So the PPA escalation rate is an input. The PPA price that you see in the metrics table is the year one PPA price. So if we go to the cash flow table, we'll see PPA price shown as energy price, we like to name things differently in different parts of the interface just to keep you on your toes. For this particular cash flow, we've got a 1% PPA escalation rate. So the PPA price is different from year to year. SAM's cash flow model is an annual model. So all of the escalation rates, inflation rates, and so on are annual rates. We don't have monthly or anything less than a year resolution on the cash flows. We're planning based on a number of requests that we've received to add a feature that will allow you to specify a different PPA price for each year in the next version of SAM, which is due out sometime later this year, late summer perhaps. Debt. So the utility IPP model and the advanced models, or the single owner and partnership models, use model debt in different ways. So let's just define some terms here. The debt fraction is the ratio of the amount borrowed to the total installed cost. A higher debt fraction means you're borrowing more, and you've got a lower cash outlay in year zero. The debt service coverage ratio is the ratio of operating income to expenses in each year. So for the commercial and utility IPP models, the debt fraction is an input, although there is a checkbox on the financing page to have SAM calculate to optimize the debt fraction for you. And then the DSCR, the debt service coverage ratio, is a result. And SAM calculates the DSCR for each year and shows you the minimum DSCR in the metrics table. For the single owner, those models assume a constant DSCR. So the DSCR is the same in every year, and you specify the DSCR you want to achieve, 1.2, 1.3, whatever it is, and then SAM calculates the debt fraction. Debt is an important assumption, and it has a big impact on the cash flow and therefore on your metrics. I'm showing you the cash flow here for an identical project, one with debt and one without. So debt has a few different effects on the cash flow. Obviously, it reduces more debt reduces the cash outlay in year zero. So the project with debt has a shorter bar here in year zero because somebody else paid for the rest of the cost. This is for an $80 million project. And then SAM assumes that debt interest payments are tax deductible. So when you have debt, you increase the cost in out years. So you have increased debt, additional debt costs. But then because of the interest deductions, it sometimes comes out as a savings. So the bottom line is that including debt in your project affects both your year zero investment and your out year costs. So it affects the balance of investment versus operating costs in the cash flow. In this particular case, our cash flow shows us a few things. We can see there's the maker's depreciation in years 1 through 5. So we see the benefit from that in these years. We can see the ITC in year 1. That's that big payment in year 1 for both projects. And then for the project with debt, the cash flow is lower than the project without debt. This is an 18-year loan. So during the loan period, we get that interest deduction. So that keeps our costs down in the out years. Whereas with the project with no debt, we don't have the benefit of that interest deduction. So it turns out that the system with no debt gives you a lower IRR when you fix the PPA price. So what I did is I ran the model with debt and found that I needed a 17-cent PPA price to get a 12.6 internal rate of return. And then I ran the model with no debt, fixing the PPA price at 7.3 to discover that that brings my IRR down and makes the NPV negative based on my assumed discount rate. So what this tells me is that given the assumptions that I made, my project is not going to be feasible if I don't borrow money. Okay, the dreaded levelized cost of energy. This is the definition of the cost, the sort of classic definition of the levelized cost of energy. So it's a value in dollars per kilowatt hour. If I take that value and multiply it by the energy generated by the system, I get the total cost of the system over its life. So this equation is the definition of the cost of the LCOE, and then if I solve for the LCOE, I end up with this equation that Sam uses to calculate the LCOE. So Sam uses this classic definition of the LCOE for the residential and commercial models. For the PPA models, we define the LCOE as the amount that the project must receive for each unit of energy to cover costs and the internal rate of return requirements. So the LCOE for the PPA projects is calculated based on the PPA price here, and it's basically another form of the PPA price. So if we look at PPA price and LCOE, we can see that how they're related. And did I forget to talk about real and nominal? Well, let me just mention it briefly here. So SAM calculates both a real and nominal LCOE. Maybe that's in the next slide. Nope, sorry. Okay. And then the real and nominal LCOE are just depend on whether we're accounting for inflation or not, in whether the LCOE accounts for inflation or not. So if we look at this table here, I've got inflation and PPA escalation rate, and we can see that if we have no inflation and no escalation rate, the PPA price, nominal LCOE, and real LCOE are all the same. If we have only inflation and no PPA escalation, then the PPA price and nominal LCOE are the same. So if there's no PPA escalation, nominal LCOE and PPA price are the same. And then the inflation causes a difference between the nominal LCOE and real LCOE. And then if we have escalation and inflation, then all three values are different. So to summarize, the SAM financial models are pro forma cash flow models from the project perspective. They use results from the performance model as input. So the kilowatt hours used in the financial model come from the performance model. You provide inputs for installation and operating costs, financial parameters, and incentives. And then the different models generate different metrics. But they all show the PPA price, IRR, and NPV, which you should evaluate it as a set. Okay, there are times when you run the PPA model when you'll get results that don't make sense. You might get an internal rate of return that's ridiculously high. You might get negative NPV or a high debt fraction. Usually when that happens, you blame the model, and then you email me and you say there's something wrong with SAM. But as it turns out, most of the time when you get those strange results, there's something going on with your assumptions. You've modeled a project that's not financially feasible. In some rare cases, it could be that SAM doesn't find a solution. And your tip-off that happened is if you see a really high PPA price, like 4 cents per kilowatt hour is the maximum, is the limit that SAM puts on the PPA price. And so if you're running the model, if you're providing the IRR as an input and SAM generates a PPA price of 4 cents per kilowatt hour, then you know that based on your assumptions, SAM was not able to find a solution. So let me just spend a minute talking about the solution modes and what's happening mathematically. So when you give SAM a PPA price, it's pretty easy for it to calculate at the internal rate of return. It just basically creates a graph like this, and then it looks up the discount rate. And it's numerically fairly straightforward to do that. And I even showed you how you can do it by hand for a very simple two-year project, just to help you understand the process. Calculating the PPA price to meet the IRR target is more complicated. So the PPA price is buried deep in this cash flow equation, in order to calculate the PPA price from the IRR, SAM has to use an iterative method, which I've outlined here. So the purpose of showing you this is just so that you know that there's this iterative algorithm that can fail if you provide it with unreasonable inputs, and you may encounter this as you're working with a PPA model. For the IPP models, we've got these additional constraints to help you out when you set up a case that is causing the search algorithm to fail, and that's just you add these constraints or check one of these financial optimization checkboxes, and then rerun the model, and that should help SAM find a solution. But as I mentioned, you're more likely to find that there's some assumption in your analysis that's causing the results that SAM is generating. So let's look at one common one, which is a negative net present value. And just to reiterate, the net present value, of course, depends on the discount rate that you specify. And we're assuming that it's representing the value of an alternative investment, and that you're trying to achieve a positive net present value for that discount rate. So if you've got a reasonable PPA price, so this is 13.8 cents per kilowatt hour, maybe for a PV system that's pretty reasonable, and your IRR target is, you meet your IRR target, it's 10%. You've got a debt service coverage ratio of 1.07. That's fairly reasonable, maybe a little low, but you've got a negative net present value. Well, what might be going on? What this is telling you is that there's insufficient income in the cash flow to meet your initial investment. And you can kind of see that from the cash flow, right? We've got a big long line for the year zero investment, and a bunch of really short lines for the in the out years, and even some negative stuff going on here. We're not earning enough revenue to cover our initial cost. So here's some possible solutions. You can increase debt, as I showed you earlier. That both decreases this initial investment and gives you that interest deduction benefit in the out years. You can try decreasing the operating expense, O&M expense. So those are the O&M costs on the system cost page. You can try decreasing the discount rate, so you can change your assumption about what your alternative investment is. Or you can impose these constraints for the utility IPP model. Okay, and a second scenario is that the IRR is too high. So here, again, we've got a reasonable PPA price. It's a little high here. The debt service coverage ratio, again, is a little high, but reasonable, and we've got a solid positive net present value. So here, in this project, the project income is more than we need to cover our initial investment. So what you can do to deal with this situation is try increasing the PPA escalation rates, increasing operating expenses, decrease the discount rate, or again, use your constraints for the utility IPP model. All right, so that's what I had for today. I realize that was a lot of information presented very quickly. We'll be posting these slides along with a recording of this presentation on the learning page of the SAM website. And I would encourage you to at least download the presentation so that you can sort of study the information. I've tried to put enough information on the slides that if you use them along with the documentation in the help system, it will help you sort out some of your questions about the models. We do have about 10 minutes or so left, so I'd like to open the floor for questions if there are any. I don't see any in the, oh, maybe there is in the Q&A. Let me just have a look there. So yeah, could we open the floor for questions by voice?
If you would like to ask a question, please press *1. Please unmute your phone and record your name clearly when prompted. Your name is required to introduce your question. To withdraw your question, please press *2. Again, if you would like to ask a question, please press *1.
And maybe while we're waiting, I'll address a couple of these questions. Here's one from Pete Shepard. For O&M inputs, can you use more than one of those three choices at once? Yes. So if we go back to the system cost page, and scroll down here to the O&M cost section, we've got three O&M cost categories. This is a physical trough system, so we've got a fuel cost for an optional gas boiler backup system. And in fact, for the trough system, we've got cost per megawatt hour and cost per kilowatt year. And so yes, the answer is you can specify as many of those as you want. SAM just adds them together to calculate the annual O&M cost. The IRR is so high because of the DSCR constraint. Yes, it looks like I've answered some of your questions. But yeah, the IRR could be high because of the DSCR constraint, so you could remove that constraint and then rerun the model to see if your IRR goes down. And will the PowerPoint be available after the call? Yes. Okay. Clarification on the nominal discount rate and the IRR. So if we go to the financing page, under analysis parameters, you'll see this is where you specify the discount rate. And again, the discount rate affects the NPV. The real discount rate is an input. And then SAM calculates the nominal discount rate based on the real discount rate. And I think I have the equation somewhere in the presentation, but it's also in help. If you want to see how SAM calculates the nominal discount rate from the real discount rate that you enter, there's the equation. And SAM uses the nominal discount rate to calculate the net present value. Okay. Are there any questions on the phone? If you've
Yes, there's a question.
Great. Go ahead.
Ray Urbesnik, your line is open.
Oh, thank you. Yeah, just I want to elaborate on that. The nominal discount rate, you said that it was equivalent to the IRR, or you said the IRR was equivalent to the nominal discount rate. When you pick and set the IRR above to a certain value, how is that being used different than the nominal discount rate?
Okay, I see what you're saying. So if you choose the if the IRR, let's see, the internal rate of return is the nominal discount rate that results in a net present value of 0. So if you choose a real discount rate and inflation rate here that result in an NPV of 0, then the nominal discount rate will be the same as the internal rate of return.
Okay. Okay, so they're one and the same when it's 0.
Right.
And the only time that becomes 0 is when you specify the PPA price, because that's what the iterative solution is trying to solve for. NPV equals 0?
So let's see. So let me just point out. So in this partnership model, we're looking at the project or after-tax NPV, or I guess it's called. Wait a minute. Well, we've got net present values from the partner perspectives, which just confuses things here. Let's go switch over to the single owner model and look at the results here. So when this after-tax net present value is 0, that's when your IRR and nominal discount rate will be the same.
Okay.
And if if you're in specify PPA price mode, then you're going to sort of have to adjust your assumptions until you get that NPV at 0, close to 0. Otherwise, you can you can play around with setting the inflation rate to 0, and then the real discount rate and nominal discount rates are the same, and then you can put in the IRR as the real discount rate, and if we can achieve our IRR target, then the actual IRR came in at 12.63, so we have a little bit of a positive NPV. But hopefully you see what I'm getting at here. Is you
iterate to solve it. My other question was, does NREL or DOE have a set of financial metrics that they would recommend to use as a standard set for comparing one technology to another?
I can't really speak for NREL or DOE, but I can say that SAM is an attempt to kind of get at that question. I think the metrics you use really depend on what the purpose of your analysis. So DOE originally funded work on SAM to create a set of metrics that it could use in its internal evaluations of programs in the solar program, and so it determined that the LCOE calculated in the way that SAM does was appropriate for its purpose. I'm not aware that there is a standard recommended set of metrics. There's a lot of discussion of metrics in the various documents that the two organizations publish, but I don't think they have a set of recommendations.
Paul, this is Nate. Can you hear me?
Yeah, go ahead.
Just wanted to add that that you're correct. There is not a set of values, but for federal projects, so that's in particular DOD, GSA, et cetera. There are people at NREL who help with the project development for a number of those projects, and OMB has released some guidelines for federal projects in terms of what you need to use for discount rate, inflation, and some other metrics. And I'm happy to help get that information. We can get it and put it up on the web, but I think that's about as close as DOE gets to having some standardization around those numbers.
Yeah, that would be helpful if you could put it up on the web.
Okay.
I have a non-related question on financials, but it's with regard to SAM. If you're running a PV model, I never can seem to find what the net AC output is.
All right, tune in next week for the PV session.
All right.
we've got one other question here on chat that I'd like to address. Maybe we can stay over another couple minutes to address any other questions. So how does SAM show the actual yearly depreciation amount, or does SAM show the actual yearly depreciation amount in the makers for the 5-year model? Okay. So if we look at the utility IPP model and go to the depreciation input page, so this is where you tell SAM what type of depreciation you want to model. So the 5-year makers, when we run it with 5-year makers, if I click run and go to the cash flow table, you can find, here's the depreciation percentages that are applied and the years in which they are applied. And then the depreciation amount is shown in the cash flow. For the single owner model, the depreciation modeling is a little bit more complicated. First of all, you can model a few more different types of depreciation, and then there's bonus depreciation, and you can divide up. You can allocate different portions of your initial investment to different depreciation classes. And so the cash flow table for the single owner and partnership models doesn't show the percentages, unfortunately, and maybe we can change that in a future version. It does show this table. So this is not a cash flow. This is not a year by year table. It's just a table showing how SAM calculates the basis for each depreciation class. So there's the gross amount, which is based on the percentage, and then there's a reduction based on whether the depreciation basis is reduced by amounts of different incentives, and then you get the final depreciable basis for each depreciation class. But there is a table in help on the depreciation input page. If you go to the help page there, where did my help window go? There it is. Okay. There's a table in help that shows what the percentages are for the different depreciation classes. Any other questions in the queue?
At this time, there are no questions on the phone.
Okay. All right. Well, if there are no other questions, then I think we'll wrap up. Thank you so much for your participation. And again, please visit the learning page on the SAM website in the next couple of days to download a recording of the session and also a copy of the PowerPoint presentation.
This concludes today's conference call. You may now disconnect.